I'm sick.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Tuesday, which means John Penn is joining me this morning. As I said yesterday, we're going to talk a little bit about, client issues, prospect questions, and we get a lot of questions by email every day. So we're kind of setting up Tuesdays to kind of go over things that may relate to you, right? So, they always say if somebody has a question, it's likely a lot of people have a question. So hopefully we're going to hit on some things that are important for you. But talking a little bit about, kind of where we are. So this week, 34% of the S&P 500 will report earnings. By the end of this week, 79% of the S&P will have reported. So there's two things about that. First of all, so far, not surprisingly, because we talked about this a few weeks ago going into this, is that we cut earnings rather drastically coming into the Q2. Well, not surprisingly, we have a very high beat rate for earnings and revenue. So there you go. Having said that, though, we did see Procter & Gamble miss estimates this morning, so we'll see how that weighs on the stock. Merck is actually beating estimates this morning by a decent margin. So we'll see. The stock's up about 2% this morning. We'll see what happens. So a couple of things, though, as we get through this. This also means that as these companies report earnings, the buyback window opens back up, so they can start buybacks. And, of course, this is mostly the biggest companies. And this week, we've got Microsoft and Apple, two of the biggest companies that buy back stock, are going to be announcing this week. So a lot of things going on this week. Outside of that, today also starts the two-day meeting of the Federal Reserve. So tomorrow afternoon, we'll get the announcement from the Federal Reserve and what they say about rate cuts, etc. So this is, whether or not we're going to get one tomorrow, highly doubt it, but you never know. There is some estimates that, there's a small percentage chance, at least by the Fed Fund futures market, that the Fed could do a surprise rate cut tomorrow, but most likely it'll be September. But they'll be laying the foundation. If they are going to cut rates in September, and this is the risk of disappointment for tomorrow, that they'll say something today about, hey, inflation's where we want it to be, where we want to get ahead of the curve, however they want to phrase it, but they'll lay some groundwork tomorrow for that September rate cut. If they come out tomorrow and say, well, we're still watching the data, right? Still not where we want it to be, that could disappoint the markets, because that would theoretically presume that maybe they won't cut rates in September, might push it out to November. That, of course, wouldn't be surprising. We've talked about before the risk of potentially influencing the election. We'll see. But tomorrow will be a big day for the markets. Friday, we have the employment report. That's going to, of course, the Federal Reserve will already have that number. So they already know what the employment report is tomorrow going for their meeting. But we'll find out on Friday. That's expected to be about 175,000 is the estimate. We've been beating that number consistently every month on foreign-born workers, etc. But the household survey has been drastically weaker. Full-time employment as a percentage of the population has continued to decline. And Friday, I've got a report coming out on the SOM rule, which is about the employment, when the employment rate is basically 0.5% higher than the average, the 3-month average. That is typically kind of a pre-recessionary sign. We're there, right? So we'll take a look at all that data on Friday. Of course, that article will come out before we actually get the employment report, but that little bit of data won't really change much of the analysis at this point. But we will be going more into the importance of employment as it relates to the economy and potential recessions, et cetera. Okay, so let's talk a little bit about what you need to know before the bell this morning. We'll go through a couple of charts that are kind of moving in the market, so to speak. So first of all, we've had this 3% correction in the S&P. We're getting fairly oversold on multiple levels, but we're not there yet. But the market did rally back above the 50. We're holding that as of yesterday. This morning, futures are pointing up a bit, so we're going to try to continue to hold this, try to rally this back up a bit towards the 20-day moving average. We'll see what happens here. But again, it's encouraging that the market right now, we've had this 3% correction. The market's holding the 50-day moving average, kind of working off some of those overbought conditions. Again, we're not through this process yet. So again, I would expect a rally to have a further corrective process here before we kind of see the ultimate bottom. This could take a while. This could be typically over in the short term. Again, if the Fed comes out and announces very bullish kind of dovish commentary tomorrow, this market is likely going to rally pretty hard for a couple of days, and then we'll see what happens after that. But again, we're kind of getting fairly oversold on multiple levels, so this is also kind of providing some of that fuel. On the other side, yesterday was interesting because as of late, it's been the story of how small caps have been outperforming large caps. That wasn't the case yesterday. S&P was up, small caps were down rather sharply, but they're very overbought here. They had this very sharp rally that occurred here for a few days. It was like, oh my gosh, small caps are here, 10% run, and then they've kind of just been stuck here ever since then. This has a lot to do, as we talked about, with that yen carry trade, because the yen has been declining, and that is a function of that carry trade, shorting the yen and going long U.S. Treasuries, leveraging that into stocks. And there's a very high correlation between the yen and the NASDAQ. So as that yen reversed, that caused that carry trade to unwind, that impacted large cap stocks. We talked about this the other day. Hedge funds are very, very long large cap stocks, very short small cap stocks. That's that short covering right there that occurred. And since that process has kind of resolved itself right now, small caps aren't really going anywhere. So we're going to see, importantly right now, if small caps can continue to rally, or if this was just kind of a little flash in the pan. As we've kind of seen previously, we've seen these kind of little pops in small caps that eventually give it back up. But outside of that, when we start looking at or kind of elsewhere around the world, emerging markets continue just to really languish here. Nothing really has been going on in emerging markets. International looks, just not a whole lot better. There's not been a whole lot of reason to be invested really in anything other than large cap stocks here for a while. This has been going on for several years. These positions continue to really kind of lag the overall markets. And we look at, international stocks back over a 3-year basis. They're not even back to previous highs yet. So again, we're still just kind of struggling in some of these other areas of the market in general. Gold has been, if it's going to cooperate here for me, gold's been kind of stuck here in the range as well, not really going up, not really going down to any great degree. Nothing really exciting happening. It's on a sell signal currently. Brent crude also on a sell signal. Brent crude's kind of retesting lows here. It's getting fairly oversold, but this, there's kind of a story now that Israel obviously wants to avoid a broader war in the Middle East. So that's been putting pressure on oil prices for the last couple of days. So a lot of that Israeli conflict premium that was put in oil prices has reversed at this point. But oil prices are getting decently oversold here, so I would expect a rally in oil prices, particularly as we move later into the summer. That wouldn't surprise me, especially once we get closer to kind of going back to school. Also, if there is a rising probability that Trump gets elected in November, that should also provide a bid for oil prices, as he's going to be pro-drilling in the country. Outside of that, the dollar continues to kind of be a story of just consolidation here. If we look back a bit, dollar really hasn't done a whole lot. It has been rising here lately, but giving a bit of strength, but overall remains fairly suppressed in a range. But again, that's just kind of the broad overview of the market. Really, the story still tends to be right now large cap stocks, earnings. Everything else is trying to play a little bit of catch up, but there's a lot of underlying pressure in terms of earnings growth on those areas. So focus on where earnings and fundamentals are. That's probably going to feed you better, at least here in the short term. Okay, that's what you need to know before the bell this morning. When we come back, we'll pick up with John Penn, talk a little bit about things that you may have questions about. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. John Penn joining me a bit.
Good morning.
Morning. How are you?
Good, thanks. How are you?
Good. A few things to really kind of talk about, but one thing I wanted to go through, we have an article posted on the website this morning talking about corrections, and it's very interesting, and I know John's been getting a lot of these questions lately, is the market's down 3% from the recent peak, and John's been getting questions along with the rest of the advisors like, oh my gosh, why aren't we selling more? We need to get out of the market. The market's about to crash, and of course, it doesn't help that there's just a tremendous number of YouTube channels and articles out there talking about, why the markets are going to crash and why all this is going to occur. But importantly, it's important to understand that corrections happen. They're normal and they're healthy. And you need corrections within a bullish trend in order to keep the bullish trend alive. The stock prices just cannot go up. But it's interesting because when stock prices are going up, we get very complacent and every day we look at our portfolio and it's like, oh man, we're just making money. We're just killing it every day. I'm getting richer every day. But there's some problems that come out of that. But I want to show you this chart real quick. This is average returns of the markets over time, right? So if you take a look at every year of the market, average returns. So when people say the market returns an average of 7% a year, that's not normal. That's not really what occurs. 73% of the time, the markets return more than 7% a year. 27% of the time, they return much less than 7% a year. But what's important to understand is that only 13% of the time are corrections greater than 10%. So if you take a look back through the course of history, only 13% of the time were there more than 10% corrections, right? 10% of corrections or less occur 13% of the time. The rest of the time, the market's rising. So corrections occur. And importantly, we have corrections every single year, right? It doesn't matter what year you're in, you're going to have a pullback in the markets to some degree. And, we can look at every year of the market and look at the intra-year drawdowns that occur. Every year we have a drawdown. Now, some years we had a year where the drawdown was 1%. That happens, right? But the average, the median is about 10% a year, right? So having a 10% drawdown within a given year is completely normal, right? That's a buying opportunity more often than not. Now, go back to that chart real quick for me, Brent. Now, just take your time. It's okay. It's okay. It's all right. Brent's having a conniption over here. Just give him a second. What's important to understand, though, is that if you look at years where the drawdowns were greater than 10%, those occurred in years where market returns were negative. Okay? You don't have, now with the exception of 2020, where we shut down the economy with that 35% drawdown, that was an anomaly. But in years where market returns are positive, you typically do not have drawdowns of greater than 10% because of bullish momentum. So when you're seeing all these headlines about, the coming recession, the bear market, all this type of stuff, just remember that's not going to happen in a year where the market's already up 14% for the year. Right? Now, could you have a 5 or 10% correction? Absolutely. Right? Very, very possible. But having a much bigger decline in a year where you're a 14% gain is not likely to happen. Now, if we get into next year and we're in a recession and the markets are down 10%, then a 20% decline is much more probable. Okay? So just keep these things in some type of perspective because they do matter, right, to your returns. We can't let we're going to talk about anchoring here in a second. But look, are there reasons to have we're down 3%, right? Is it over? Is it done? Right? We had a 5% correction back in April. Is it over? Is it done? Could we have a 5 to 10% correction still? Yes, we still expect a 5 to 10% correction sometime probably before the election for a variety of reasons. But that doesn't mean it has to happen, right? We can expect it. Doesn't mean we're planning on it, right? We're just saying, hey, look, there's risk out there. So we're not taking on we're not like leveraging our portfolio to the upside right now. We're more concerned about potentially hedging a bit, but we're still very long equities at this point. We're 53% of our 60% allocation. We're at a very long streak of bullish behavior. Investors have been very bullish for a very long streak, right? We haven't had a big correction. So over the last 180 days, can't read my own writing. But that is a long stretch, right? Which means we're going to have a correction at some point. That bullish behavior, everybody's on one side of the boat, that bullish behavior will get reversed. And there's another way to kind of look at this, which is looking at kind of the streak of risk on, risk off behaviors. This is from Sentiment Trader. And when you have very long stretches of these risk on behaviors, you typically have a corrective process. Last time, if you look back to the left of that chart, it's not shaded, but you had a decent streak. It was about 90 days of this risk on behavior, and then you had the correction going into 2020. So, those are just things to pay attention to. So yes, we have the ingredients for a bigger correction, right? 5 to 10%. But again, that doesn't mean it happens today. Also, we run our own fear greed indicator, which is based on how investors are allocated. They're very strongly allocated right now, right? The allocations are a very high level of equity exposure. So again, that also kind of contributes to the ability for the markets to have a 5 to 10% correction. Could that be larger? Absolutely. But in order for you to have a much bigger correction, credit spreads, as we talked about before, the only thing you need to pay attention to is credit spreads. Credit spreads are your best indicator for bigger corrections. And right now, credit spreads say there is no risk of a bigger correction in the markets. So in order to have a 20% drawdown, you need to see credit spreads starting to widen, and you don't have that right now. If they start to widen, we'll tell you. But right now, that's not the case. So let's talk about anchoring for a moment, because this is the mistake, and John's going to agree with me on this. This is the biggest mistake everybody makes as an investor. I'll bet every one of you in our chat right now can tell me what you paid for your first house, right? If you're in the chat, just throw a number in there of what you paid for your very first house. It doesn't matter how long ago it was. Just put a number in there for what you paid for your first house. The reason that you can remember that is it's a big life event, right? We're anchored to that number. And if we sold that house for a higher value than what we originally bought it for, we consider that a positive event, right? That was good. If we sold it for less, that was a negative event. Doesn't matter what all the expenses and everything else you spend on the house in between were. We don't factor that in. We just know the beginning value and the ending value, and that's what we sell it at. So it's the same thing with the stock market. Yep. See, here's chat telling me they know exactly. See, you're all anchored to your first house. Everybody knows that. John, what was the price of your first house?
$65,000.
There you go. Everybody knows it. Mm-hmm. It's now, John. When was the last time you bought a hamburger?
Actually,
yeah,
this weekend.
Really?
Yes.
So you probably know what you paid for it.
I do.
Okay. Yeah.
So, well, it may not be a fair comparison to what hamburgers cost in Houston because I was out in the parts of East Texas getting burgers out there, and they weren't as pricey. But I know what burgers cost in Houston.
All right.
Yeah.
But what was the price of a burger when you bought your first house?
I don't remember.
There you go. Because it wasn't a life event.
That's right.
Right? We remember life events. So this is anchoring, right? So this is anchoring. We anchor to important things. And when it comes to our portfolio, we're all anchored to the high watermark. What was my portfolio value yesterday, the end of this month, last week, whatever it was? We anchor to that number. So when there's a decline in the market, we go, oh my gosh, I'm losing money, right? But you're not. You're just losing recent gains. You're just giving back recent gains. You didn't realize that money yet, right? It's just a capital gain. Now, I'm not saying that it's not detrimental that your portfolio is going down in value, but we have to anchor to a better number. What was my portfolio at the beginning of the year? What was my portfolio 2 years ago? The best anchor, if you're going to anchor your portfolio to a number, what was your portfolio value 2 years ago? Anchor to that number and then move that number every year. 2 years or 3 years gives you a much better anchor point to work with to keep you from making psychological mistakes. So if I look at my portfolio 2 years ago and it was $100,000 and I'm now $140,000 and then my portfolio goes down to $135,000, I'm not panicking, right? I'm not sending emails to John going, oh my gosh, John, why did we lose $5,000, right? You're just giving up some gains. That's all it is. But my portfolio is still very healthy from where it was 2 years ago. So it's a much better point to anchor with. And it reduces that pressure to make psychological mistakes. And the reason I bring this up is we get emails all the time from clients, from prospects, et cetera. And they're like, oh my gosh, my portfolio is down $20,000. I'm so upset with my advisor. And I'm like, okay, well, hold on a second, first of all. What's the value of the portfolio? Well, it's $2 million. Okay, what's the percentage of 20% of $2 million? It's 1%. The market's down 3%. Okay, you're doing much better than the market, right? Perspective is incredibly important, which is why if we're going to anchor, don't anchor to change in value from the most recent high watermark. Anchor to something that matters to you, which is, are you progressing towards your goal? And that's why if you give yourself a 2 or a 3 year window, it'll help you better visualize your progress towards your goal. The markets are going to have corrections, right? Don't make bad emotional mistakes on top of a minor correction. All right, we'll come back. We'll let John weigh in on this. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the last 2 years, there's been a massive drop-off. Like, nobody's naming their kid Alexa anymore. But yeah, because you go, Alexa, stop that, and all your lights go off.
The Real Investment Show podcast.
And I'm sure the kids at school were getting teased. You know, hey, Alexa, ask a question.
Same show, your schedule.
I hadn't heard of any kids being named Siri.
Not yet. I'm sure there are. I am sure there are. And there's probably some kid named Bixby somewhere.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Now, I warned y'all about the chat rules. And Jerome and our chat member Jerome Powell says that I'm old enough to remember when we used to use well oil for fuel.
Those are fighting words.
Them's fighting words. But more importantly, what Jerome Powell doesn't understand is that I remember when we had to catch our own whale.
And then turn it into oil.
And then turn it into oil for fuel. So, I mean, you know, that was back then when men were men. Not this pansy stuff where we just turn on a switch to
catch our own whales.
Exactly.
And we liked it.
Had blubber for days. The stuff you can do with well blubber, it's amazing. Anyway, a couple of things. So, John, I know you have some comments about what I was just talking about in terms of, you know, anchoring, which is one of the, you know, it's because it's a fascinating. It's everybody does it, right? It's just, again, it's how we are as humans, and we just have to understand that anchoring is one of our flaws, and we just have to make sure we're aware of it so we can be better investors.
Well, and you were talking about looking at your numbers and maybe looking at your portfolio value or doing a comparison maybe on the last 2 to 3 years from a time horizon standpoint. And it's one thing to look at it from a performance standpoint, but sometimes I think a lot of people fail to realize when they're looking at their number that they had in their portfolio 3 years ago, 2 years ago, especially in now if you're in that phase of your life where you're in more of that distribution phase and you're pulling from it, You're taking expenses from it, or you just needed to tap the portfolio for whatever reason. I think sometimes folks fail to realize, well, how much did I actually withdraw too?
Right.
They look at their balance 2 years ago and they go, oh my gosh, well, here's where I am today. Well, okay, well, hold on a second. Let's go back and let's look at how much have you taken out for your living expenses. Have you been taking out money for your property taxes, et cetera, whatever that might be. And you don't realize how quickly all of these expenses can add up, and we can show you and say, hey, since, December 31st of 2020 or 2021, here is the amount that you've taken out of the portfolio. And you go, oh, well, hey, my portfolio is hanging in there pretty well then, right?
Right.
So you got to put that into context too, I think.
No, you do, because, again, where the mistakes that we make as individuals when it comes to investing, and by the way, Brent, if you can just bring up the screen just real quick. In today's article that's on the website, realinvestmentadvice.com, I go through this. It talks about corrections are normal. But in that article towards the bottom are a set of kind of rules to follow in terms of trying to defeat this, anchoring issue, right? So if you want kind of just a desktop set of rules to kind of follow, so as you're making investment decisions, you kind of look at this set of rules and go, okay, am I making any of these mistakes, right? Because again, this is what leads to bad outcomes. But to your point, John, is that the one thing that we do is we just, again, we look at our portfolio value, and again the other worst thing we do is we have our portfolio allocated to stocks and bonds, whatever it is, and then we look at the market, and there's all these people on the media going, well, if you the market was up 15% last year, if you didn't beat the market, then blah blah blah, right? Well, that's terrible advice, right? Because the only way you're going to beat the market is to be more aggressive than the market itself, right? And like this year, if you want to beat the market, you've got to be in just 7 stocks. That's it. And now, great, you're beating the market. But how much risk did you take on for that? And then at the same time, you look at your portfolio, like my portfolio was only up 7% last year, or 6%, right? Man, my advisor sucks. But to John's point, well, how much money did you take out, right? Because that impacts your returns, right? How are you allocated? Because that impacts your returns. If you're in a 20-80 portfolio because you're super conservative, you're not going to beat the market, right? So you've got to factor all these things in, but the problem is that the media, both bullish and bearish, right? I mean, look, there's guys out there with every YouTube channel, every YouTube title is the end of the world, and then there's guys out, the media is out there with, it's the biggest bull market ever, and blah blah blah, right? So you don't have anything in the middle, right? You just got these both spectrums of just either uber bullishness or uber bearishness, and we get all tied up into that, and we forget what's really important, which is just growing our assets over time, trying to reach our financial goals.
Well, it is, and all of a sudden, well, it's not all of a sudden. This has been developing for quite some time, and I know we've discussed this before, but now it's like when did investing become a game? It's like, well, why do I need to try to beat the market? Or what is that? The market doesn't know me. The Standard & Poor's 500 index doesn't know me. The NASDAQ doesn't know me, nor does it care. So why am I trying to beat this random index out there by taking all this risk? Well, I want all the upside. I want to get the upside. I want to get the upside of the market. I want to beat the market. But at the same breath, it's like, whoa, market's down 3.5%. Oh, I'm getting scared. Well, hold on. Mm-hmm. You're not going to, if you want to get all the upside of the market, you have to be willing to take on that volatility. And if the fear of loss is keeping you up at night over the fear of losing out, you're more concerned about the fear of loss. You don't need to be in an all-stock portfolio. Quit trying to beat something that doesn't know you, right? Mm-hmm. So to Lance's point, sometimes folks say, well, golly, John, the market's up 14% this year, or it was up 15% last year, whatever that might be. Hey, I was only up 7 or 8%. Okay, well, what is the rate of return that you need to make over time for this to work for you? Oh, well, my hurdle rate, or that rate of return that I need to earn over time, is about 4.5% a year. Okay, hold on a second. So your hurdle rate, or the rate of return that you need to average over time, is 4.5. You were up 7 or 8% last year. You almost doubled the rate of return that you needed. So that's how we have to think about it, right?
Well, again, these are just all the things that lead us to make poor investment decisions. And again, look, we do a variety of things, right? We chase yield.
Yeah.
Right. And I can't tell you how many people they call me up and say, oh, I found this stock or this dividend, this dividend yielding stock or whatever that yields 10%, 12%. What do you think? Well, you take a quick look at the fundamentals of it. It tells you why it's got a 10% yield, right? And there's a lot of instruments out there that pay, higher rates of return. That's great, but you have to understand what the drawdowns are and what the drawbacks are to a lot of those things, internal expense ratios, all those type of things. When things often sound too good to be true, they often are, right? And you can wind up giving up a whole lot to get something you think is really good right now. So just be careful. There was a really good question in chat, from John talking about all of our lives, we've been increasing at 8% on average in the stock market. True statement, going back to 1900. And can we be changing into a downward sloping GDP long-term trend due to demand, demographics, et cetera? We have been. For 24 years, GDP has been declining. Actually, I take that back. I'm sorry. We've been in a downward sloping GDP trend since 1980. So for the past 44 years, we've been in a downward sloping GDP trend, and yet stock prices have been growing on average between 7 and 8%. It would be lower than that had you not injected $43 trillion worth of liquidity into the markets between 2009 and 2020. Right? So present. So we had this massive surge of liquidity that boosted returns to 12% over that period of time on average, which has kept the long-term rate of return higher than GDP growth. And again, yes, to your point, GDP growth is slowing. We're going to run between between 1.8 and 2.1% on average long-term, right? Because of demographics, demand, et cetera. And that's going to continue to weaken as we put on more debt, et cetera, which debt is derogatory towards economic growth and activity. And that's not going to change. So inflation is going to decline, economic growth will decline, and ultimately, without ongoing stimulus rates, long-term growth of stocks should return back to a function of economic growth, interest rates, and inflation, which should be somewhere around 4% on average versus 12, right? But again, it'll depend on QE and more government spending and this thing, that thing, and the other thing. There's just a tremendous amount of liquidity running around the markets right now that has to get absorbed at some point, and it will, but it could be much longer than we anticipate. But it's a good question, John. But the what most people don't understand is that we've been in a long-term decline in economic growth, real economic growth, since 1980, since Reagan took office.
Yeah, and I think it's important, because we talk a lot about, in addition to the investment side of things, we talk a lot about, the financial planning aspect of things, the retirement aspect of things. And you're right. When there's a great comment that Mark made here about in the chat about that's the issue that he has with an advisor. I cannot tell you what I want or need yet. Life happens. For now, our goal is just to have the biggest bucket possible. And there's some validity to that when it comes to looking at financial plans and retirement plans, because we are trying to predict the future,
right?
And and now all of us as investors, we're trying to become fortune tellers, and we're trying to get our crystal balls out. And you're right, you don't know what the future holds, and you don't know what the future holds for your own life too. But there's got to be a starting point where you at least where you say, okay, here's what I know now. Here's what I know today. This is my situation right now. Where would I or my family or my significant other like to go? What would we like to do at some point? And let's just put some realistic, forward-looking assumptions to try to build this. And you're right, lives change. Your life is going to change, and the plan has to change too. But you got to start at least thinking about it a little bit as far as, well, here's where I am now. Where do I want to go? And what's the best path for me to get there? And Lance, how you were just talking about historical returns. What if markets don't give us that moving forward? We need from a forward-looking return estimate. We think it makes sense just for planning purposes, just to use a little bit more of a conservative forward-looking return estimate.
Yeah, I want to come back.
Right?
I want to expand on that a little bit more because that is the biggest problem: is how much money do I actually need for retirement? And there's a bunch of just bad narratives out there about, oh, you just need X times your income. No, we'll talk about why when we come back from the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, just I want to kind of just elaborate a little bit on John's last point, talking about, the comment in our chat, which was great, which is, I'm just trying to save money, but I have no idea what it needs to be, to get there. And there's a lot of really bad advice out there in the markets. And, for instance, one of them I see all the time is, well, just all you got to do is just take your current income and multiply it by 25, and then that'll be what you need for retirement, because at 4%, then that number should give you, what it is that you need to retire on, right? The problem is that doesn't really work. As a good example, there's, a lot of articles out is like how to get to $1 million in savings. And they tell you, what you need to do to get to $1 million in savings. And, we're all kind of hung up on this, right? It's like, if we can just get to $1 million, man, I'll be good. I'll have $1 million in the bank. Well, $1 million in 1980, the cost of living is about $35,000 a year. So $1 million at 4%, no problem, right? Well, $1 million today isn't going to cover your cost of living anymore. At 4% or even at 10% in a lot of cases for people, $1 million just ain't what $1 million used to be. And that's the thing you've got to be really careful of, is that saying, okay, well, look, if I can just get to 25 times my income, I'll be great, for retirement. The problem is that that's 30 years from now. And the cost of living is going to be higher because of inflation over time. Life is going to change. And, things are going to occur. And whatever you're living on now is not going to be what you need to live on in the future. And so here's the problem with this, is that there's a lot of unknowns. But we have to have a goal, right? And so if, for lack of a better term, you can say, look, I'm 25 times my income. That's my goal, right? At least that's a starting point. And you have something to shoot for. So if I can do this, right? I save, I max out my 401k, I max out my Roth IRA, I contribute X amount of dollars a month to an S&P index fund, and I let that grow over time. And you'll have a goal to shoot for, because again, with financial planning, you can sit down and it's just math, right? You say, if I save this much and the market does this over time, even with variable rates of return, I should be close to this goal by the time I retire. And then as you get there, you begin, each year you review your plan and start making adjustments, right? Because of inflation, because of market returns and all these type of things. But at least you have a goal to focus on, and you can calculate how much return you need, how much you need to save to get there. And I wouldn't use 7% rates of return. Markets average 7%, right? Markets do not compound at 7% a year. Losses matter. So I would use a number. I'd say, look, if I'm going to expect a 4% rate of return, so how much do I need to save? That's going to increase your savings rate. But if you count on a much lower rate of return to grow your wealth, you're going to be much more secure in reaching your retirement goal. And if you make more, great. That's just gravy, right? That just makes things easier on you. But you don't back up and start saving less. You're always trying to save more. The biggest bulk of your wealth will come from what you save, not from what you invest.
Yeah, and so many great points there. And again, using a more conservative, forward-looking rate of return. Because if you earn more, hey, great. But what if you don't? You just can't plan for it. Hey, for my sometimes I'll hear, John, for my plan to work, hey, I'm counting on an 8% a year return. Okay, to compound at 8% every year, it's like, well, markets may give you that, but let's talk about that a little bit, and let's see what happens if you earn just a lower rate of return moving forward. Hey, you know what? You may need to work more, or maybe you can't fully retire at 63, 64, 65 years young. Maybe you still need to work a little bit, still have some earned income, so you're not having to fully rely on the portfolio or what your other cash flows are at that point, right? But there needs to be a point where you start just kind of formulating and getting these ideas together. And the more that you go down the path, the more you can hone and polish and really tweak that plan, where it really becomes a better representation of what you're trying to accomplish. So you kind of have to start somewhere. But Lance, to your point, I mean, out there, the media doesn't do us any favors, because you always see those commercials. What's your number? What's your number?
That was terrible.
What's your number? And it's
worst ever.
And I was asked at one time on an interview, they were like, well, John, how much, for today, how much money do people need to really have to retire? And they didn't like the answer that I gave. And it was like, well, that depends. I mean, it's such a unique, specific circumstance. Everybody is so different, right? But so the media is not really doing us any favors there. And, and so going back to some of the anchoring of some of those emotional points that Lance was talking about earlier, having that plan in place, it's there to help you from making knee-jerk reactions. Just all of a sudden, that's going to really sway you or pull you from the plan. It keeps you grounded, right? I mean, great example. Had a conversation with a gentleman yesterday. Super nice guy, very, very smart. And he said, John, I've allocated all of my investable assets to the international and the emerging markets, and I am 100% international and emerging market. And he just flat out said, I missed the boat on the growth and large cap stocks for the last number of years. And I said, well, what led you to make that decision? He goes, well, I thought this year, 2024, everybody out there was calling for the demise of the dollar. And I thought by investing 100% in the international and the emerging markets, I was going to protect myself from the demise of the dollar. And he has missed out.
Yeah.
Right. And and I said, we're all human. We have that emotional wire in us where we sometimes we overanalyze and we lead ourselves to these conclusions like, well, we know this is going to happen. I spoke with another guy yesterday. Mm-hmm. Again, brilliant engineer. Not going to say where he works, but brilliant.
Center point.
No, brilliant. But he is so convinced that the market will have. Next year, it is going to come down by 60%.
Yep. A lot of those headlines.
And I am not going to invest right now. But in the same breath, he looks back and he goes, but I should have invested when the market did this in 2007, 2008. When the market pulled down in Q1 of 2020, I should have invested right there. And I said, well, why didn't you? Mm-hmm. Well, it didn't feel right at the time. Well, let's say the market does have another egregious pullback. Will you have the discipline to invest then? In other words, I think sometimes, and the media doesn't help us with this at all, but we're all waiting for that perfect time to get started. There isn't a perfect time to get started, right? Just start. That doesn't mean you have to go all in now, but just start to get some money to work. Get over that initial hurdle just so you can start, right?
This is our biggest challenge.
Yeah.
That and again, like I've talked about before, is that, what I do in our company as I manage the money, myself, Mike, and Nick Lane, and we're the least important part of the whole shop, right? It's just the asset management side.
Well, I disagree.
But I understand you disagree. But but the point is that this is the hardest challenge, which is how do you take somebody that's out of the market and get them in the market? That's the hardest part, because everybody's so concerned about, well, what if I buy now and it's the peak of the market and I lose a bunch of money? There's never a perfect time to get allocated to the market, ever, right? It's just one of those things where you just kind of have to hold your nose and wade into the pool a bit and get your feet in the water and begin to allocate the portfolio. Once the portfolio is allocated, then it's easy, because then you just respond to market risk, right? If the markets are declining, you sell assets. When markets are rising, you add to assets. That's the easy part. But getting in, right, especially going from nothing to something, is the hardest thing to do. Psychologically, there's a million reasons not to do it. But this is why we have a process of just wading into the pool. We get you in. It takes 12 to 18 months, but we get you into the portfolio. Then it's just a function of managing the portfolio from that point against declines and those type of things. But to this engineer's point of view, it's if all the headlines are like, oh, 60% correct. We're not going to have a 60% correction next year, most likely. Could we have it? Yeah, but most likely not. Those are very rare events that occur. They're outlier events, and it's going to require some type of geopolitical, financial, credit-related crisis, which we don't have any of that in the process right now. Doesn't mean it can't crop up, but if we do have that, right, we're going to see it coming. As I said earlier, credit spreads will tell us that there's risk, and when there's risk like that evident, you begin reducing equity risk. But we don't have that right now. There's no risk in the markets according to credit spreads at the moment.
Yeah, I think sometimes, and I also hear this too in those statements, it's like, well, John, I've been out for so long now. Now if I start to get in, I don't want to be the last one holding the bag, right? It's like, I don't want to be the one to get in at the last minute where everybody else has, then all of a sudden, yoink, market has a big pullback right out of the gate. Okay, I get it, right?
But that was the feeling in 2019 when we were having a market melt up in 2019. And, coming off that 20% decline in 2018, the market shot up higher in 2019. And people didn't want to get in because that was they didn't want to be at the top.
That's it. So it's hard because, when just like here as of late with markets pulling back by 3.5%, give or take. Yep. It feels a lot worse than what it really is because we're so trained. Well, markets go up. Hey, this is easy. And all of a sudden you get a little bit of turbulence out there. And you're like, oh, so 3.5%, that's so, like Lance mentioned earlier, that is normal. If markets pull back, have a little bit of a breather, that gives you an opportunity to kind of add or nibble at a better value. It may not be the rock bottom price, but at least you're getting a better value than where things were before. And it's amazing when I'm visiting with folks and I'll say, well, if things go on sale at the grocery store that you really like, what do? I buy more of it. Why aren't you doing that with stocks? Oh, well, so it's so emotional, right?
It's all about emotion. All those trading rules on the website in today's article, realinvestmentadvice.com. If you like the show today, please like and subscribe. We certainly appreciate that help as well. If you have any questions, feel free to email us. If you got a question for John, send us an email. More than happy to help you out any way we can. realinvestmentadvice.com. Have a great day. See you back here tomorrow with Danny Reliff. See you then.